All right, so I am going to get started with some announcements while you eat. And there's tiramisu there. If you haven't gotten it, there's some biscotti, I think. How was the meal tonight? Fabulous? Great. I am recording these announcements. The camera can't see you, they can see me. So if you aren't here and you missed it and you haven't been to one of these events, take that as at least the meal was great, okay? We'll try to record a huge round of applause at the end of it. Now, I'm not asking for that, so don't do that. No, the meal is really good. I'm glad you were here for that. The servers will continue to bring decaf and regular coffee if you want it, so just continue to ask for that. And get up and grab dessert. Get up and use the restroom. Liz is out there and can direct you, so there's really nothing that can offend me. If you have to get up and leave a little early, I had one come up and say they have a babysitter issue. You can go ahead and do that. On July 17, and on your little form that you can fill out, you can check whether you're interested in coming to that, and we'll put you on an interested list. It doesn't commit you. But on July 17, we're going to be showing this video or this movie that we produced as a group, and I'm going to show you a 4.5-minute trailer for that right now. So this will be a movie to eat dessert by.
Hong Kong Trade Development Council.
Oh, really?
They love that place. They really?
We've got a lot to offer, that's for sure. So they were from Hong Kong?
Yeah.
Okay.
One lady was.
You speak Chinese?
I do.
You do speak Chinese? Okay. That's why you were at lunch with them, probably. Not me. Thank you. Yeah.
I'm taking off on it because I've got kids to
Awesome.
help my wife to do.
I'm glad you guys could make it to the first half. For the first time, that's the one I wanted you to see, so that's great.
We'll see you on
Awesome. If you want to just fill out that form and have Liz do it, she'll call you. Good deal. Thanks, guys. Have a good night.
It's beyond the human mind to comprehend all of the variables. The financial equivalent in the 21st century is the fog of investing. How do you navigate the incomprehensible variables, predicaments, and the realm of uncertainty surrounding investment decisions? How do you find your way to the simple goal of building a retirement portfolio to live the golden years with the money you worked for? How exactly do you escape this dense shroud of utter confusion?
Good to see you.
Navigating the fog of investing.
See this program in its entirety, featuring the financial world's most widely recognized and respected experts, authors, Nobel laureates, esteemed professors, and those who bring academic wisdom to the investing process. They will debunk the myths.
If there was one person in these 700,000 brokers we have in this country who truly, really knew what was the best investment in any given day and the best time to buy and sell, he'd be so rich that Bill Gates would be working for him.
They will rebuke the myth makers.
I think he's probably the antichrist of investing. I think he's probably doing more general harm to the investing public than any one individual that I can think of right now.
There's lots of interesting things to do in life, and one of them is not throwing your money away. I want you to read about it in paper.
The redemption of investing prudence is at hand. How? Simply by telling the truth.
Market timing, by and large, is a guessing game, and most people guess wrong. If something seems too good to be true, if you have to rush to buy into something, that's not for you.
This program is a scathing rebuke of the commercial retail financial industry and its powerful myth-making marketing machine.
Nobody has successfully predicted
the long-term trend of the market.
The biggest lie is that someone knows what the best stocks are in advance. That someone is going to be able to tell you, and/or if you just hire them to manage your portfolio, they'll be able to pick out the best stocks so that you can get all these huge rates of returns.
See navigating the fog of investing.
The idea that you're going to hear something on CNBC or Bloomberg or any of the others that's going to put you ahead of the crowd is in fact very dangerous.
Don't pick stocks, don't pick styles, don't pick managers.
Brokers add cost and subtract value. That's why people shouldn't use them.
The professionals themselves are in a fog. They don't know. You know, they don't know that stock picking, market timing, and track record investing are speculating and gambling.
So on July 17, you can write or check that box that says I'm interested in attending the FOG event. We're going to do it at MCG Cinemas. I think it's a Wednesday night, Tuesday night, I can't remember, maybe a Wednesday night in July. And this is a great place for you to bring a friend or a guest. So it'll be a popcorn and candy and just a night at the movies about investing. I mean, that is exciting stuff. But it's good, and it's helpful information, and it'll help you. So consider that. And now I'm going to just do a few more announcements, and we'll get into our next presentation. Tonight, I've talked about this card. If you fill that out and you're new, and you say you want to have a phone call with me, a coaching session with me, you'll receive an investor inventory, which is a pamphlet that you can read, and a CD that you can listen to anytime in your car. And so take the time to fill that out, and you'll receive those from Liz, and then she'll contact you to schedule that appointment. I'll talk about that at the end again. And in your packet, this is as much for those who are guests as those who are have been investing with us for a while. You have a highlighted, or not a highlighted, but an underlined sheet that looks like this. And if you've paid attention at all to your statements, this is the first page of your statement. It's the general information. Your name is not on this, okay? We're not going to look at your returns. This is the returns of the market in various indices. And I want to just spend a couple of minutes going through it, because most people, I think, flip right past this page and go to their money. And how much money do we have? Did we make money or lose money? And certainly, probably, that's what I do. Where's my money at? But go back to this one. I just want to highlight a couple of things on it. I just took a few minutes to underline a couple of items. This is 2012 year end. Mark Mattson writes this. And the first paragraph, I underlined something that probably no one predicted. Greece's stock market was up over 30% in 2012. Who heard someone at the end of 2011 saying, let's buy Greece companies? 30% increase in Greece stock, and you own them if you were investing here, because we simply rebalance into everything we know we ought to own. You don't own a lot of them because we own 13,000 companies in 44 countries. We don't try to own one or two stocks. We own many, and so this was an ownership position that you had. The next one I underlined is in the second paragraph. It says, during the past 3 years, investors have poured nearly $700 billion into bond funds while pulling nearly $300 billion out of stock funds. The last 3 years have been very positive in the stock market. Investors have done what they feel is right, not what has been right. But by and large, net redemptions in stocks have been in the billions. And then a few paragraphs down, alternative investments such as hedge funds are on a 4-year decline. These are very highly speculative funds. And modern investment theory, the next box here, is based on the premise that individuals are rational in their approach to financial decision making. Their key objectives should be to maximize wealth, minimize risk, always acting in their own best interest. In reality, most investors who lack the help of a coach make irrational decisions influenced by mental processes and emotional factors. This is why we see some of the things that we comment on above. The reason I like these few paragraphs, you can read them, they're different every quarter, is it will give you a side-by-side approach. Every time you hear a news presentation about the market, or you read an article online or on Money Magazine or something, you'll hear something different. Nothing you read is neutral. If a human being wrote it, it has an angle, right? Nothing is neutral, nothing. We can try to be objective, but absolutely nothing is neutral. Mark Madson's writing here is not neutral either. His angle is investors need to be coached and disciplined to stay invested, and the market does the work, not the managers, right? You're going to hear that in here, and if you start to read these once per quarter, you will start to feel like, hey, what I'm hearing over here sounds different than this. This is a good commentary on what's happened in the market. There's nothing wrong with commenting on market returns and what's happened in the market. The problem comes when you start to try to make predictions based on that. That's where the destructive patterns come. So this I commend to you on every one of your statements to read. It's a good idea to get through and do that. So next we're going to go through the risk presentation that we have been promoting. See if I can get this to show up on the full screen. If I haven't lost my clicker. Putting risk together in your portfolio. Any questions about the announcements, about the next presentation, anything at all before I move on? Great. Charlie, I made a nice pause for you, so now you can cut there, start the next one. I always forget. I said, Evan, you're not pausing. You need to pause. Okay, we're going to go on. Great. Putting risk to work for your portfolio. Perhaps no greater area of confusion, misunderstanding, misconception among investors, certainly even among investment advisors or financial planners, than risk. Most only have a cursory knowledge of it and don't certainly understand all of it. As we were putting this one together, I was surprised at how many areas of risk need to be managed. Some can be managed very easily just by making a few decisions. Others we just need to be coached through and are a little bit more difficult, but we can do it. I was the president of the Financial Planning Association here in mid-Michigan years ago for a couple of years in a row. And so I was in charge of the membership coordinators, of the speakers, of all of the workings out of the financial planning organization here in the mid-Michigan area. And so 40, 50, 60 financial planners would show up every week or every month to a presentation that we would put together. Invariably, the presentations to financial planners would be a topic about something that the person was an expert on, annuities or mutual funds or whatever. And invariably, they were related to a product sale, or the angle that the presentation was given, because it's a room full of financial planners, was, how do I sell this product? And in fact, the speakers that had been coming were broker-dealers of large companies that wanted to come and sell their products. So a big insurance company would come in and give a presentation on annuities or on insurance products. Well, to a group of big financial planners, this is the kind of information when financial planners go for education or when they go to be informed, and you could get continuing education credits for this stuff, and all it was a sales presentation. And so we tried to get real data in front of people, real helpful information, but people weren't necessarily all that interested because it didn't help them sell a product to help them make a commission. So the ones where we had some really good, robust teaching on risk or standard deviation, those are the loosely attended ones. And the ones where a rep was there and offset most of the cost for lunch, that's where the people kind of came in droves. It was pretty frustrating. And there's a reason why most financial planners don't really have a robust knowledge of some of this stuff. It's because they're not motivated to learn it. They're not gathering it on the financial planning level. There's a vast difference in knowing risk exists and truly understanding it, and only by understanding the many forms of it can you become clear on how to make it work for you. Risk is required to get a return. This is a cost of capital story. If you want a guaranteed rate of return, you will get inflation returns. You'll get a bond market rate of return. In the 80s, that was 8, 9, 10, 12%. That's what money cost if you wanted to lend it or borrow it. Today, that's going to give you an annuity rate of about 2.5 or 3%. Risk, if you want to gain a better rate of return, needs to be taken and can be reduced or minimized if you understand all the different various kinds of it. And so first, I'm going to unsettle you a little bit more, maybe like the first seminar, because I'll show you a lot of different kinds of risks you probably didn't know existed, and then we'll talk about how to differentiate or how to diversify or how to reduce them. So the different types of portfolio risk. Is this little bouncing bothering anybody, or can you see it? I'm close to it, so I see a little bouncing. Is it a big deal? Not a big deal? Okay, good. Business risk is having a sizable portion of your portfolio in a single company. I'm not covering it for you, am I over there? Okay. I have a client who has worked for the same company, or a prospective client, we haven't worked with them directly, who's worked for the same company for years, I think 30 years. Their entire 401k is in the stock of the company they work for. Talk about putting all your eggs in one basket. Not only is your paycheck coming from that company, also your stock returns. And this portfolio was in the 250 to, 300 range at one point in 06, 07. And then it went down with the market, and then as it started to come back up a little bit, there was a sale of this stock into cash. And out of the 270, which admittedly should have been more had they been diversified, I think there's about 175 left, and it's still on the sidelines. It's still not in the market because there's just a fear about that. I've owned this one stock for this long. I don't know exactly what else to do. There's a business risk. The total stock market went down about 55% from 07, end of 07 to the beginning of 09. This stock went down about 60%, so there was a greater risk. But there was a lot of uncertainty as well, and that person had a sizable portion of his portfolio in a single company. That's a business risk. Market risk is having a sizable portion of your investments in a single market sector. I see this most prevalently when I evaluate someone's 401k plan. They'll have 5 or 6 or 7 different mutual funds, but when I look inside the mutual funds, I'll see mostly large U.S. companies or large international companies, and as we learned in the previous presentation, those tend to move similarly to each other. And so you have a market risk if most of your investments are in one or concentrated in one asset class. On average, when I analyze a 401k plan, on average I see 60 to 70% of the total funds in large U.S. and large international companies combined. And that's considered market risk. There's not a lot of diversification benefit there. Interest rate risk is the risk that interest rates will increase from the ones you've locked into with your current fixed income investments. This is abundantly prevalent in fixed annuities. If you own a fixed annuity and you bought it in the last 12 months, now you might hope interest rates rise, but you really don't because your income is fixed at this level, and interest rates that rise in the future you can't participate in unless you sell what you have here with a penalty and you get in. So interest rate risk is that interest rates could rise. Long-term bond funds have this risk associated with it because if you buy a long bond, you're holding on to it. This is essentially most prevalent when you own an annuity or a CD or a single bond. Okay, so you can end up with interest rate risk that rates will rise after you've locked in. Different on a mortgage. You lock in on a fixed rate mortgage and then rates rise, you don't mind so much, right? But when you're the bond purchaser, the lender, that's when it matters, right? Inflation risk, this is probably most prevalent with annuity owners and those who are retired and wanted some kind of a fixed payment that they could rely on, right? They bought into the idea that they needed to make sure that that money that came every month never went down. Well, the other thing they ensured is that it never went up, right, when the cost of goods did. And so inflation, we're going to talk about a little bit tonight. It can be a factor. We've had inflation in this country. I'll make the case, I may make the case, maybe for another time we'll make a better case, that ever since we dropped the gold standard, we've had inflation since the 60s. So you return to sound money, you can eliminate or remove inflation by and large. Well, we're not there, we'll have inflation. Whether it will be hyperinflation, I'll talk about in about 30 minutes. But inflation can erode the buying power. So if you have $10 today, or you have $10 20 years from now, you have the same amount of money, but you don't have the same buying power if the cost of eggs and the cost of milk and the cost of gas has risen, right? It's inflation risk. Regulatory risk, the risk that when the government changes the tax laws or other regulations affecting business, it'll have an adverse impact on your portfolio. Who owns real estate investments? Who didn't sell their last house, but rented it out and bought a new house? Half of America, right? In the 80s, often because of some regulations that were favorable to investing, many people bought investment properties. I know my family did. We owned an investment property. It was a great tax shelter. You could write off all kinds of stuff. And then the regulatory environment changed. The government changed the tax code. You can no longer write that stuff off. And guess what happened to the value of real estate? It just plummeted because it was no longer a desirable tax shelter. And some people owned it. They didn't even care if the real estate went up in value. They were saving so much in taxes, it made sense just to own it. And so then they dumped it, and the property values came down for a period of time. Real estate investment trusts are a way to buy real estate in kind of a mutual fund, and this was also subject to regulatory risk as well. Liquidity risk, risk that you can't sell an asset when you need the money. A CD can have this liquidity risk because you pay a penalty often to get the CD back if it's before the maturity period. Annuities, again, if there's an early payoff fee. Some of you here have gotten out of an annuity paying a small early payoff fee because it was worthwhile getting out of it. Liquidity risk. A REIT as well would often have liquidity risk. You have to wait until an apartment complex sells or something inside your real estate investment trust before you can get your money. So you buy in and you get these rents and you get these capital appreciation. Your value, your paper value looks nice, but you can't sell it unless someone else wants to buy in. And it's kind of dangerous. So oil and gas contracts are similar. Liquidity risk is a real issue. Opportunity risk is related to some of the others, and that is when you make one investment, you often keep yourself from being able to make another investment. So you lock yourself into one investment, like a low interest rate. Now you have an opportunity cost because interest rates have risen and you could have gotten a higher rate of return. So opportunity risk is a real risk that we need to understand. Default risk is a risk associated primarily with bonds, and it's the reason we own short-term bonds and not long-term bonds. Bonds are simply debt instruments, and when you buy a bond, you're lending your money to the bond issuer. And when you lend your money to someone, there's always a risk that it might not be repaid. The entire move of billions and billions of dollars from stocks after the tech bubble burst into long-term bonds in the early 2000s was based on the premise that mortgages always get paid off. They always get paid off. Well, sometimes they don't, but then the house always goes up in value, and you can always sell the house and pay off the mortgage because homes never really go down in value in this country. That was what we were being sold at Matson Money and as a group. Just put the long-term bonds in. It'll bump that value. Your investor clients will be excited. Get the long bonds in there. It's a value benefiter. It'll bring that rate of return up. Well, why are 30-year interest rates a higher rate than a 15-year rate when you borrow money? Because 30-year money is riskier to the lender, right? The bank is giving you the right to have that money for 30 years. A 15-year mortgage, you can command a better rate because you're giving them their money back faster. So when we build a fixed income portfolio or a bond portfolio, we choose short-term bonds over long-term bonds because we have a much higher guarantee of getting that back. And bonds inside of an investment portfolio is simply to mitigate risk. We don't look for return with bonds. And so default risk can be mitigated. We'll go through that. So you're going to get, if you look on your just printouts, we didn't print the entire package because that can be a little much, but pull this one out. We're going to get to this one. For those of you who want the right boxes checked, you are going to get them. We're going to get the answers here in a minute. Systematic risk is the kind of risk that is systematic. It applies to the entire market. You can't really hide from it. Stocks or equities, if you're in the market, you're subject to market risk. This is a risk that the market could go down, and we know it can. Inflation risk, we know that stocks do pretty well against inflation. I'll show you that in a little while. And then there's regulatory risk. Systematic risk, you really can't exit that by being in stocks. We can mitigate it through diversification. I'll show you that. But it's systematic. Bonds or fixed income investments have an interest rate risk and an inflation risk that just are inherent in owning them. Unsystematic risk is risk that you don't need to subject yourself to in either of these categories, but many investors do. And these are business risks, liquidity risks on the stock side. On the bond side, liquidity risk, opportunity, default, and business risk. All right? These are the unsystematic risks. They're not systematic to the entire market. They're subject to how you are in the market. All right? And you have choices in how to invest, and you can avoid these. So this is a helpful little graph. I wanted you to at least take this home today because it gives you the 8 kinds of risks along the left. And I'll go through the green section first. We'll start with the individual company. If you own an individual stock, you have that business risk. You certainly have market risk. You have inflation risk. You have regulatory risk. And you have liquidity risk. A single company, you may not be able to sell that if you own just a single company, because sometimes you can't, if I own IBM and no one's buying right now, you can't necessarily sell it depending on the company. If you own, instead of just an individual company, let's say you own the S&P 500, an entire segment. Well, when you do that, you avoid the business risk. You've diversified from one company to 500. So you've eliminated one of the risks, but you've kept all the others. You still have market, inflation, regulatory, and liquidity. Now, when you diversify in the entire market, or in those segments, small, large, international, emerging markets, when you really diversify among the broad market, you can actually get rid of the liquidity risk because you can own an index type fund, and those always have a price and they always have a value and they're always tradable. And so you have the least amount of risk owning the entire market. So you can reduce the risk that you're under to just the systematic risk. On the bond side, the business risk exists if you own the bond of an individual company or the individual municipality. Interest, inflation risk, liquidity, opportunity, and default risks. You have 6 of them here. If you own a segment of bonds, let's say you own a number of different corporate bonds of 3-year bond level or 3-year bond value or duration, you get rid of the business risk and you get rid of the default risk. And if you own an entire market of bonds, so you choose all of the small or all of the short-term bonds or all of the long-term bonds, you can just bring it down to interest rate risk and inflation risk. You can even avoid the market risk on fixed income. So this is a good graph, and it explains why we are an entire market group, why we want to really diversify. And diversify is one word that explains what we're doing. We want to gain more exposure. That's another word that explains what we're doing. You can diversify, as Jim Cramer would tell you, with 5 or 6 stocks, right? You can. It's diversification. If I own one company versus 6 companies, I'm diversified more than if I owned one, if I own 6, right? That's diversification. It's not all that helpful. I mean, it's not really helping you. 6 companies is still quite a bit of business risk. But if you really diversify, and that's why we're in 44 different countries, we're in 13,000 companies worldwide. If any one of these companies or 50 of these companies flat out went out of business, any one of them makes a pretty small difference in your portfolio because we own so many. So methods for managing the portfolio risks. We've talked a little bit about that already. Diversification is really the key. Multiple holdings help mitigate certain kinds of risks. Methods for managing risk, business risk, diversification in equities and bond holdings. I want to go through this one quickly. Market risk, diversification in equity holdings. Interest risk, diversification in bond holdings and owning short-term versus long-term holdings. So if we own short-term holdings, 1 to 3 years, they're always maturing. We can always go back to the market for more quickly. So we can get into higher interest rate markets more quickly in short-term holdings here. Inflation risk, owning equities to offset the inflation risk for bond holdings, owning equities for longer periods and holding fixed income for shorter periods. This is key. Most investors, as we saw earlier, own equities or stocks for short periods. Every 3 years they make a change. They either change financial planners or they change strategies or they change mutual funds, right? We own our equities for a short term, and then to try to gain return back, we own long-term bonds. It's the exact opposite approach to the one we teach. The short-term bonds are the one that will always give you positive return in a much more regulated, a much more regular way. It'll always get you back into the market with short-term bonds again. And holding stocks for the long term is what will benefit you against inflation over long periods of time. So we want to own our stocks for a long time. We want to own our bonds for a short period of time. And both of those will give you more stability and more safety. There's regulatory risk. You want to diversify in equity holdings, liquidity risk, invest in liquid mutual funds and short-term fixed income investments. So again, stay away from REITs, stay away from oil and gas contracts. Those kinds of things lock you in. Opportunity risk, avoiding investing in long-term bonds or products with surrender penalties like annuities. And then default risk, diversification in bond holdings. Any questions about that or the previous slides that we have shown on diversification? How many of you found 1 or 2 kinds of risks that you didn't know was there before? Great. The rest of you are going to give the next presentation. That'll be perfect. Just kidding. So here's that CPI again. The CPI is the Consumer Price Index. It's the measure of inflation. 1-month Treasury bills is a good indication of short-term bonds. It's a good index to use for short-term bonds. And then the S&P 500 is a good proxy for the market, right? 500 largest U.S. companies. And here's the performance there. If you adjust it for inflation, CPI obviously goes to 0 because CPI is the measure of inflation, or one of them. So you take away inflation, you get 0. You adjust the monthly T-bills for inflation. You take this number, subtract that number, and you get that as an annual return. And if you adjust the S&P 500 for inflation during this long period of time, you get about 6.59%. There really isn't a 20-year period where you don't get a benefit over inflation by owning stocks. There are a couple of them. I'll show them to you. But by and large, stocks will give you, on average, a 6% benefit over inflation. T-bills will not. If you're in something that's not qualified, like a 401k plan or a Roth IRA, if you're in just a mutual fund, you adjust for taxes at a 30%, both federal and state tax bracket. You're in the negative returns here, you're still positive with stocks. Again, owning stocks for the long term at some amount is what you need to have in order to keep up with inflation over time. Most of us, when we think about risk, when we're answering the questions about risk, when we go online and say, what's my risk tolerance, the only risk we have in our minds is market risk. What is my risk to my account dropping? Equally, and on the other side, there's inflation risk. What is my risk to the account that I'm in not keeping up with the cost of goods increasing? So that's an important one to watch. And then the longer you hold equities, stocks, the lower the chance of suffering losses relative to inflation. So if you own a stock portfolio for 1 year, 64% of those years, 55 years out of 86 years, would have beat inflation. Okay, there are negative years, right? Inflation was 2% in 2008, and the stock market did poorly. But if you hold a stock market portfolio for 1 year, 64% out of 86 years will be better than inflation. If you hold that portfolio for 5 years, you bump that up to 72%. 72% of the 5-year periods over that 86-year period are going to be positive relative to inflation and taxes. 79% when you hold it for 10 years. And if you hold a portfolio for 20 years, 61 out of 67 10-year periods in 10-year chunks, dropping a year and picking a year up every time you chunk it out, will be positive relative to inflation. Do we do a 20? I don't think we do a 20. Yeah, that's the 20. Yep, good. So the longer you hold your same stock portfolio, the greater the chance of you having a return that's positive versus inflation. So increasing. And the number of years out of, I think it moves to 99%, or even higher than 99%, 66.5 or something years out of 67 that are positive. This is just positive relative to inflation, okay? Inflation has averaged 3%. Getting to 20 years, you're almost guaranteeing that your portfolio will be positive during that period of time. Conversely, if you hold low volatility fixed income investments, so short-term bonds, for 1 year, 40 out of 86 times, it will beat inflation. For 5 years, 36 out of 82 5-year periods will beat inflation. The longer you hold fixed income products, the less often it will beat inflation. So again, we don't own fixed income products for return. We own them for stability. We own them because they stabilize your investment portfolio. We own stocks for return. So when we talk about your investment portfolio, one of the first questions is the market question. How much of the market ought I be in based on my age and the amount of wealth that I have and how much I need this portfolio? The longer you hold volatile low volatility fixed income investments, the higher probability you will lose to inflation. This is the annuity story. Folks who buy into a 10 or 20-year annuity will generally always lose buying power over a 20-year period of time. And if they own a stock portfolio with even 25% stocks in it, they'll generally gain buying power throughout their retired life. You don't have to take on a lot of risk to gain buying power, to gain something over inflation, to get a raise when you turn 75 and another raise when you turn 80. Okay? Short-term fixed income exposure in a portfolio will reduce the volatility. So that's why we use fixed income. This was the conversation, does it pay to extend maturities for fixed income investments? This is the graph that tells us the optimal period of time for which we buy bonds. You have bonds of a 1 month, 6 month, 1 year, 5 year, 20-year category. And the crossover is 5 years, where the annualized return of the bond fund no longer outweighs the risk associated with owning it. This is, again, academic. We just want to make sure that we're buying and owning the right scenario. So we want to own a mix of bonds in this 0 or 1 to 5 year bond category. Again, short-term bonds like 15-year mortgages are more likely to be repaid, right? Finding the optimal maturity and holding period. Optimal maturity in bonds is 18 months. At that point, the yield goes up much more slowly, so we kind of concentrate in that area. We're going to go through this next. Any questions about that? I wanted to talk about hyperinflation. I mentioned that I would. Any questions about that risk section before I move to the next one? Great. How many of you thought about hyperinflation in the last little while? Anybody know how to define hyperinflation from a percentage standpoint? What inflation needs to be in order to be considered hyperinflation? They say it's 50% inflation per month. Something like 13,000% inflation per year, that's considered hyperinflation. There are 21 countries in the last 25 years that have experienced hyperinflation. Anybody name any of them? That's one of them. Brazil is the one we're going to talk about later. I don't think so. Let's see. I don't think so. Yugoslavia, Turkey, Romania, Poland. The example everyone gives is the Weimar Republic, Germany, right, in the early 1900s. But 21 countries over the past 25 years. Out of these 21 countries in the last 25 years, we have one example of a country that had a stock market that could be tracked to talk about what happened in the stock market during that. Now that's a telling stat. It's a stat from absence, so it's not something that can be anything more than something that's telling. I'm not showing that that proves anything. But one of the things that as I read about hyperinflation, and if you would Google, like I did, explain hyperinflation, or is hyperinflation coming to the United States, or some of those Google's searches, you can find a few articles like I did, and I wrote them, and I read them, and I wrote them all, so just Google, you'll find my name all over the place, hyperinflation. Freaked out about it. The articles, by and large, say no, hyperinflation is not coming to the United States, and a similar indicative reason is because we're a little bit more established. They're talking about transferring from an economy that is force-driven of a dictatorial government, transferring to something that's a little bit less, or transferring back the other way. You see these wars that are tearing up the economy, and one of them, they talk about Yugoslavia really putting the Weimar Republic inflation to shame. And the reason it did is that 60% of Yugoslavia, the roads, the businesses, the buildings, they were all gone. That's the kind of thing. Now, they always list things like printing money and taking on excessive debt as a country. But one of the articles explains that whereas we have been, quote unquote, printing money in this country, the monetary supply that comes from the US government, or the state money, makes up only 15% of the monetary supply in this country. 85% of the money in this country is still in the banks and in the companies of this country. And so whereas the monetary policy of the Fed is very, very loose, they're adding money like crazy, the monetary reality in the private sector is extremely tight. Also government created, they say, because the Dodd-Frank bill came and tightened down businesses, and the low interest rate stance kept businesses and banks from lending money to each other. So the government is pumping all kinds of money into the banks, but the banks aren't lending it out. And so where there's a huge inflow of money on a very small sector, the major part of the economy isn't putting that money in the economy. So the the graph that shows how much money is being pumped into the country is still below projected levels for this time period, even though the government stance is so loose. That reason and many others say that I have to agree to this, say that the chances of hyperinflation in this country are extremely, extremely low and not very likely. So I wanted to start with that disclaimer, but I also wanted to say, what if it did happen? I mean, we talked about that last time. You can go to my YouTube page or my website and soon check out the presentations that we gave in January. We talk about different White House administrations, different Senate administrations, different House administrations, a GDP that's positive or a GDP that's negative. Inflation, well, inflation we'll talk about tonight. All of these things, is there a reality of all of these things that causes us to make a prediction about the stock market? There really is no correlation to any of those things. Well, we wanted to talk about inflation. It's a little bit of a different story there, because inflation does seem to have a correlation with returns, and that correlation is positive. Now I'm going to move from this to a video in a minute that will hopefully put this in perspective, how serious hyperinflation is. The doomsday scenario: sovereign debt fears, global monetary crisis, socialism in America. If you want to read about what socialism, or hear about what socialism does, we did a seminar on that in January. Increased socialism actually increases returns in stock market portfolios. Who'd have thought? To a degree. Massive entitlement programs, tax increases, printing money to pay off debt, repay with deflated dollars, triple-digit inflation, all of these things. Now, does anybody know what this is from? This is going to really set the tone for the seriousness of our conversation. If you can recognize who that is, that's our friend Bill Murray. Hyperinflation, we're going to call it of biblical proportions. I checked it, it's clean. You have to check Bill Murray all the way through. You can't just play it in a room full of 70 people. Biblical proportions.
What do you mean this Old Testament again, man? Real wrath of God type stuff. Fire and brimstone coming out from the sky. Rivers and seas boiling. 40 years of darkness, earthquake, volcano, the dead rising from the grave. Human sacrifice, dogs and cats living together.
Mass hysteria, mass hysteria. I thought that did a pretty good job to set the tone. And to put hyperinflation in its proper context, we should be laughing a little bit. I never want to laugh about potential realities, but I don't believe hyperinflation is something that we need to worry about. But let's say that they are right, okay? Let's say we have massive inflation and America goes into full-blown socialism. Again, you can check out my website to hear a little bit more about socialism. But does that correlate to the death of equities? Okay, are equities going to die as a result of massive inflation? Fears about a dollar crisis. In just about every one of those scenarios, and again, every one of those scenarios, the 21 countries that went through hyperinflation, there was a monetary crisis. There was a crisis in their currency. So what if the following happened? Okay? What if, in 1988, stamps were 25 cents? I think they were. What are they today? 42, 45 cents? Okay. 46? That's inflation of about 2 to 3%. So the U.S. Postal Service, whether they can make money at that or not, this remains to be seen, but that's how inflation is hitting the U.S. Postal Service. And let's say the investor had $2.50, and the investor could buy 10 stamps, right? Simple math. What if the investor instead invested $2.50 in equities in his country, or in our country, instead of buying 10 stamps? Okay? Then in 2009, what if the stamps cost $60,412,124, and the investor now, instead of buying the stamps, which would have mailed 10 letters, he invested the money and now he has $6 billion plus? What if that? Now, the assumptions that I was using for these numbers correlate with the inflation experienced in Brazil from 1988 to 2009, and they correlate identically with the equity returns in that country during that same period of time. Think about it. If you own $1 and you could buy eggs at Meijer, can you buy eggs at Meijer for $1? You can't. $2? $3. You can buy eggs on my street for $1.50, I think. But if you owned stock in Meijer, who has the ability to raise the price of eggs, right? Which one is better in an inflationary period? If you look at Brazil, the only people who did well in Brazil during that period of time were equity investors. Precious metals lost buying power. Certainly anyone who held cash lost money big time. But if you were in the equity return, in the local equity market there, you ever wonder why in your portfolio you own, if you're in a 95% stock portfolio with us, if you're in an aggressive portfolio, 50% of your money is in the US stock market and only 45% of your money is in the 43 other countries, right? We do that because your currency and your livelihood and your income is all from this country, so we overweight to the country that you're in. If you lived in Europe, you would overweight to the European or wherever the euro is traded. That's where you would overweight, or you would put most of your money or half of your money there. The return in the local equity market, in Brazil anyway, and remember, we had 21 examples of hyperinflation in the last 25 years, and only one of them had stock market returns that could be tracked. And this is in the last 25 years. So again, Brazil was relatively coming to its own. It was probably still considered an emerging market in 1988, but it was still something that was coming into its own. And the return beat inflation still. If the dollar weakens significantly, how would hyperinflation and currency devaluation impact U.S. investors? Although it is unlikely to occur, we have a historical example of hyperinflation making you money. So the total inflation in Brazil was 24 billion %. 88, 89 through 94, these are the worst years. 24 billion % was the total change. The Reis was used in 88. The Cruzeiro was used from in 1942, from 42 to 67, the Cruzeiro was used. Cruzeiro Novo, the new Cruzeiro, was used, 67 to 86. Then they went to the Cruzado, 86 to 89. Who'd have thought the next one would be the Cruzado Novo, right? Then they went back to the Cruzeiro from 90 to 93, the Cruzeiro Real, and now the Real is being used in 94. I think I have those pronunciations right. That's their currency exchange. What happened if an investor in Brazil held cash? In 1988, 1 billion Cruzado was just about 14 million US dollars. That was the exchange rate in, this is a painful slide. This is what they would have had in US dollars 20 years later. How did Brazilian equity investors fare? Inflation, 24 billion %. The local equity return, 242 billion % equity return. The cost to purchase a stock in a company or in the total market in Brazil went up that much. The total return of the Brazilian market, your investment in the local market held its value even in the face of severe currency devaluation. If you invested in Brazil, your purchasing power not only didn't decrease, it increased tenfold. The local equity market provided a real return on capital, purchasing power increased. I almost didn't show this because it's, again, I think the stronger case, frankly, than these numbers, because we have 1 out of 21 that we could actually even track. The stronger case is the fact that the 20 of those 21 examples didn't even have a viable stock market, which says that the article, the folks who are writing articles about whether or not hyperinflation is a reality for us are probably right. We don't have a war-torn nation. We have buildings coming down tragically every now and again, but we don't have 60% of our infrastructure being destroyed. That's the order of magnitude that causes something like this, where the country has no answer other than to print money. And they just, even, there was one point that even the printing of money, I just learned this past week, even the printing of money in this country isn't really printing money because it's all being sold on the bond market. So the government is trying to make the case that they haven't really done anything wrong because they're going to get all this money back. They bought into General Motors. They got it all back with a return for the American people, they're saying, right? And some of this is true. I have to hand it. I don't agree with what the government's doing in getting involved in this way, but they are doing it in such a way that they're getting a return. Ben Bernanke did his PhD on the Depression and how the Depression could have been handled better. Well, why do you think he got the job he got? Some say that he's been a genius. I think he's a tinkerer and he's spending too much time and involving in price fixing, and that it's not good for us. But it's not like these people are stupid. They're really not. Fear about future weakness of the U.S. currency is understandable, but we can't predict future policy or actions that will occur. If the dollar weakens, expected real returns of equities over the long term are still positive. There's a real sense in which your dollars in your bank are less safe than your stocks in your stock account. There is a real sense that that's true. And most people look at it and say, my checking account is safe, and my stock portfolio is risky. And there's a sense where that's true, depending on the kind of risk you're talking about. But we have to have a fully orbed view of risk, or we're going to end up with too much money in cash, right? And end up with 21 cents. And we don't want that to happen, even in a small way, where the price of eggs doubles over the next 20 years, and your money and your income didn't, because you weren't a part of the market in any way. So there's no guarantee equities will provide a real return due to the nature of risks, but this is a striking example of inflation. Again, just one example where you can see the big difference. So I want to end with the 20 must-answer questions, and you have those either printed for you or in the back of your booklet if you came here for the first half of the session. Before I do that, any questions on what we just talked about at all? I sometimes feel giddy about the fact that there are 60 or 70 people here listening to stuff that I get really excited about. And I know that you're excited about it to the extent that I understand it, and it's important that I understand it. You don't need to understand it. And yet you have these questions. And I think many financial advisors would rather you not bring up inflation because, gosh, how do we talk about inflation? But you're thinking about it, so I might as well talk about it and at least give you what we can know about inflation. Can I promise you hyperinflation won't happen? No. Can I promise you the stock market will beat hyperinflation? I can't promise that. We have examples. We can talk about it. I don't think it's all that likely. And so we just want to talk about what you're thinking about. That's what I hope to do. If you're ever thinking about something, shoot me an email. If you read an article that you would like for me to comment on, send it to me. I read everything my clients give me, even book recommendations. I've got one recently I've got on my desk I'm going to read. Love to read that kind of stuff with you. So let's go through this. Here are the rules to the 20 must-answer questions, or the one rule. And the one rule is this, that as you answer these questions, yes or no, you can answer yes if you're a 100% emphatic, I know that the answer is yes to the question, all right? And if you've been here 10 times or 15 times, answer them again because you'll get more yeses every time you're here. My goal is that clients who've been with us for years get close to 20 or 20 of them answered yes emphatically. If you don't know the answer or you don't know that you know the answer, just write no or leave it blank. We're just going to count the yes answers at the end and check your progress and see how you're doing. This is our standard for coaching. So people say, Evan, you're a coach or an advisor. What does that mean? We coach to a standard. These are our standards. If you don't coach to something, you're making it up. So this is ours. Number one is, have you discovered your purpose for money, that which is more important than money itself? Do you know why you save money? Dollars and portfolio value doesn't mean anything unless you exchange it for something. So what is your reason? Your main reason? Question 2, are you invested in the market? Should be easy for those of you who are investing with us. Yes, you are. If you're in a 401k, you likely are. If you don't know, you can check no or leave it blank. Check out how this one's worded. I say you need to be able to get 20 yeses to have the most peace of mind, and I'm saying that you have to be in the market to have some peace of mind. That correlates a lot with what we've been talking about tonight. I think some market exposure is required for peace of mind against inflation risk, okay? Now, I also want to talk about peace of mind. I don't think ultimately peace of mind comes from anything that's written on that paper, but investor peace of mind, or peace of mind that you're doing the right thing with your investments is what we're talking about. Question 3, do you know how markets work? Do you know how prices are set? Question 4, have you defined your investment philosophy? 5, have you identified your personal risk tolerance? Could you put a number on it? Do you know how to measure diversification in your portfolio? You consistently and predictably achieve market returns. If you're a client of ours and you saw your last statement, you could check yes to that, because yet again, another quarter, 22 years and running or something like that with Mets and Money, you're achieving market returns. Have you measured the total amount of commissions and costs in your portfolio? They can be measured, even the hidden stuff. It can be found, we can show it to you. So if you're new to us and you'd like us to evaluate that, that's part of the process. Do you know where you fall on the Markowitz efficient frontier? That's the graph where we showed the various different classes, conservative, moderate, growth, and aggressive. Do you know where you fall currently? When it comes to building your investment portfolio, do you know exactly what you're doing and why you're doing it? I don't mean this tongue-in-cheek. I've had a couple of clients who've been able to explain it, or who say, yeah, you know what, I think I know exactly what we're doing. I think I know exactly why we're doing it. I'd really like my clients to be able to say that this is probably the litmus test for me. If we're getting a yes on that, I'm feeling really good about it. It's not that difficult. It's sometimes difficult to keep all the components together, and that's why coming to these on a regular basis can help with that. Are you working with a financial coach versus a financial planner? And I make that distinction, someone who's helping you remain disciplined versus someone who is working on product sales or I mean, we need insurance. I'm not against insurance. I'm not against wills and CPAs to help us with these things. These products are important, but we don't need to pay commissions for them. We can pay fees, small fees, and get the services we need. Do you have a customized lifelong game plan to guide your investing and spending decisions? Correlates with your income, correlates with your investments. Do you have an investment policy statement? When you opened your accounts with us, you got one. It essentially tells me what to do on your behalf in certain market conditions. Ups and downs, we rebalance, we keep you consistent. Some of you are on the kind of investment account that becomes more conservative over time automatically. Others of you are remaining static for a period of time and you'll revisit it over time. This investment policy statement tells me exactly what to do so that you know what will happen. Have you devised a clear-cut method for measuring the success or failure of your portfolio? How do you know when to fire your investment coach or your investment advisor? You fully understand the implications and applications of diversification in your portfolio. Could you explain it to somebody? Why do we own more small companies when we retire? It's a good question. You have a system to measure portfolio volatility. Are you aware of the incentives that brokerage firms and the financial community have when selling commission-based products? I think the one piece of information that anyone considering buying an annuity should get before they make the purchase is just simply to know the amount of commission that the annuity salesperson is going to get paid for selling it. Just find that out. You'll be a little less excited about the product as soon as you hear, sometimes. Or you'll get a better return because they won't want to show you what they were planning on making. Up to 10% sometimes. You know the 3 warning signs that you're gambling and speculating with your money versus prudently investing it. And I'll give them to you again. You just heard them this morning. It's earlier today. Was it this morning that we got here? Boy, that would be pathetic. How long does it take Evan to unload the truck of information? 12 hours. This is track record investing, market timing, and stock picking. Thank you. I have to answer no to question 18 tonight. Can you identify the cultural messages and personal mindsets about money that destroy your peace of mind? Commercials, seeing friends have something that you might want or doing something that you might want to do. This gets back to your purpose for money. Do you know why you have the money you have? Do you know what your purpose is, what you're about? And then 20 is one that you can answer yes to if you're wanting to make a change, shifting your personal experience of money investing from a scarcity mode, and scarcity, I mean scarcity of information and knowledge and understanding how it works, to an abundance mode where you understand how it works, you know what your objectives are, etc. So So be sure, if you would please, to take this card and fill it out for me, especially if you're new. I would like to meet with you. Answer yes to that box and just hand it in to Liz. We are not a high-pressure organization. If you have that first call with me and you say, Evan, this just isn't for me, that'll be the end of it. I mean, you may get an email from us until you take yourself off that list, but we're not going to be high pressure about that. But we do want to meet with you. We do want to give you information that you need and you want. So that's what I have. Is there any questions that I could wrap up with at all from anyone that has been here a while or anyone new? Great. Thank you for coming. I'll hang around. You can ask me a question personally if you'd like to. Thanks for coming.